Welcome to Daybreak Australia. I'm Haidi Stroud-Watts in Sydney. We're counting down to Asia's major market opens.
I'm Annabelle Droulers in Hong Kong. The top stories this hour. Tech drives a US stock rebound with the earnings season about to kick into full swing. Bloomberg Intelligence sees profits for the Magnificent Seven rising 38% in the first quarter.
Morgan Stanley shares sliding the most in 5 months after a report that US regulators are scrutinising its efforts to prevent potential money laundering.
And President Biden commits to deeper security ties with Japan and the Philippines as Prime Minister Kishida tells Congress that China poses a threat to global peace.
We do have, crossing the Bloomberg just now, unemployment data out of South Korea. We are getting the unemployment rate seasonally adjusted for the period of March, coming in at 2.8%. That is bang in line with expectations and picking up from that 2.6% that we saw in February. We are also, of course, counting down to BOK decision date as well. The labour market is likely seeing some loosening in recent months. We've seen hiring in the services sector really slowing. Bloomberg had estimated 2.8% for the jobless rate to rise to, but still, if we put that into context, 2.8% still below the post-pandemic average of 3.3%, which is seen as the natural rate of employment, so neither inflationary or disinflationary there. So that weakening that we see in domestic demand will be something that the Bank of Korea is looking out for. They are expected to hold during what's seen as a transition period with that meeting today. Taking a look at how we're faring when it comes to just an hour away from the start of major markets trading. We're watching the won, of course, that's tumbled to that 17-month-long low before that BOK meeting, but elsewhere around the region we're seeing a little bit of downside, sort of dampening risk appetite across the board. Sydney futures down by just about 0.4%. A pretty mixed picture because we did see tech that rally. They're lifting US stocks. We'll be watching for tech, AI, chip-related names in this part of the world as well. Nikkei futures to that point looking a little bit more optimistic, and China futures lagging as well, Belle.
And Heidi, just a little bit of breaking news crossing the terminal here. We've got Peru out with a central bank decision here. Very unexpected, actually, because out of the 13 economists that were surveyed, only one saw this cut coming through. The rest were expecting it to be held, but a drop in that reference rate by 25 basis points to 6% there. You can see in this chart, this is looking at Latin American central bank rates, but Peru is the line there you see in purple. So it is a lot lower than its other counterparts in the region. Again, a surprise coming through because actually last month inflation slowed a lot less than had been expected, so still remaining above the Peru central bank target band. So that's the outlook there for rates. Of course, rates really playing into the session intraday today. We actually had a US PPI inflation print out if you take a look at what we're seeing here for futures coming online, but a US PPI print that came in lower than what economists had been expecting, so that was a bit of a relief. Otherwise, the focus really in the session came down to big tech, because we've got the earnings season about to kick into full gear later today, actually. US tech stocks, though, very much the focus for us. We saw Alphabet, for instance, inching closer to that $2 trillion mark. Amazon hitting a record high. Apple jumping on plans that it's going to be revamping its Mac line as well. So they were some of the ones moving to the upside. Morgan Stanley, you can see they're under pressure. Bank names JP Morgan, Wells Fargo, Citi, they're all reporting their earnings later today, but Morgan Stanley tumbling on a news report that regulators are probing its wealth arm. Let's take a look, of course, at how this is playing into futures as we come online here. NASDAQ, S&P 500, a little bit in green territory here, fairly flat at this point in time. Still watching the bond yields, of course. We saw Treasuries yields moving just a little bit higher to 4.58% for the 10-year in the prior session, and watching crude as well, given that we do see the questions around supply pressures coming through and how that is going to really affect the dynamics through the end of last year. But certainly, as we said, that focus coming down to the Fed. And we actually heard from the Fed Reserve Bank of Boston President Susan Collins here, and she's again urging for a little bit more patience when it comes to expectations for cuts. Take a listen.
The recent data have not materially changed my outlook, but they do highlight uncertainties related to timing and the need for patience, recognizing that disinflation may continue to be uneven. And this also implies that less easing of policy this year than previously thought may be warranted.
Well, let's bring in Nick Shoemaker, who's a client portfolio manager at Drummond Capital with us here in Sydney. Nick, great to see you as always. The
Morning.
balance of risks seems so fine at this point, right?
Yeah, absolutely.
That caution seems to be the name of the day. What are you expecting from the Fed?
I think the Fed needs to be really careful. There's a lot of parallels now, I think, to November 2021 when the reference to transitory was removed back then. So I think their credibility is quite at stake now. I think they did move too early with their pivot in December. We were of the view that inflation was going to be sticky in services for, ever since then. And you've got 3 monthly prints now that are showing that you have a trend, not to mention the fact that commodity price, the whole commodity complex is blowing out. And if we get crude energy having another rally from here, I think we could find ourselves in quite a precarious situation with regards to inflation. So it's looking like November increasingly could be the first cut. And we've got people like Larry Summers saying it's a 25% probability that you might have a hike this year. So it's certainly getting trickier by the day for the Fed, particularly in a contentious election year.
Are you taking short positions in treasuries? I know you're heavily underweight global bonds.
Yeah. We're not taking outright short positions, but we haven't had any global bonds since that kind of bear steepening around debt deficit and supply last year. Yeah.
You're also not particularly keen on global equities either. So talk us through kind of how you're navigating the uncertainty.
We're close to neutral. We're just modestly underweight global equities, but we have been adding to risk really from the first quarter of last year, just as the economic data was getting better and better. US activity data this year has just been continued to be resilient and surprising on the upside this year. I guess just given the narrow market leadership with tech, earnings for the last quarter last year were about 55%. We do have strong price and momentum trends there, but just again, narrow market leadership just has a little bit of, just kept us a little bit cautious. But we did add to global small caps about 5 weeks ago. If you look at the S&P 500, you've actually had industrial small and mid caps outperform over the last 10 years, even though global small caps have underperformed the S&P 500. So there's a lot of beneficiaries in small and mid cap stocks that will benefit from reshoring and geopolitics. But any kind of China exposed names you'd probably want to be short, just given Trump and tariffs are increasingly a risk.
And what's also been interesting this year, Nick, is the run-up that we've seen in gold prices, perhaps without any sort of real catalyst. Yeah. But you've added gold miners into your strategy as well.
Yeah. So the gold price really started to take off in early March. There's a few things behind that. There's the central bank buying. There's been massive buying by China, Chinese households as well. I think there was just the expectation that real yields would come down. But even last week when we saw bond yields sell off, you saw gold continue to rally. So I think there is that geopolitical bid becoming more relevant and just an inflation hedge, which I think is only going to continue given the data that we've seen this week. And I think the fact that you've seen energy and gold rally together, again, just shows that kind of war premium is being embedded into markets from the flare-up in the Middle East.
Yeah, and actually, thinking about that war premium, it makes me think of haven demand, and then I think about the Japanese yen. But of course, it's really also been that dollar story, that yield story. So do you think yen at these levels, could we see it getting even weaker?
We could see it get even weaker. I think an interesting thing to watch would just be whether the Bank of Japan has to start intervening. I think they intervened about 4 times in 2022. So if you see dollar yen cross about 155, I think there'd be some intervention. Just over the last few weeks, we saw the BOJ remove negative interest rate policy and yield curve control. Certainly, I don't think they were thinking the yen would drop. That's going to bring in the wrong type of inflation. So again, the Bank of Japan, after coming out of just one of the most unorthodox regimes with regards to monetary policy, has got quite the challenge ahead too. But one really key thing to watch there, Annabelle, is just that 10-year JGB yield. I think it's about 0.84 now. If it gets close to 1.5, you could start to see that big repatriation of capital and that kind of global carry trade being a source of volatility, which could also put upward pressure on long bond yields in the US and Australia to a lesser extent.
Nick, do you want any exposure directly or indirectly to China at the moment, particularly as we see Australia-China ties continuing to improve? We're expecting the Premier's visit in couple of months. Yeah,
look, it's an interesting one because it's probably one of the most shorted markets. There's a lot of bad news priced in and things only need to get less worse for that to bounce. Manufacturing data started to improve there, so you have seen more evidence that you could get Q1 growth hitting targets without the property market recovering. For us to invest, we'd need to see a lot more in terms of fiscal policy and reforms around local government debt. So we're still quite cautious, just given the experience over recent years.
Nick, always great to have you with us. Nick Shoemaker,
Thank you.
Client Portfolio Manager at Drummond Capital. Well, coming up on Daybreak, Apple preparing to overhaul its entire Mac line with a new family of in-house processors designed to highlight AI. We get details on that Bloomberg scoop later this hour. But first, maritime security topping the agenda at the Trilateral summit between the US, Japan and the Philippines. We get some of those highlights from this key meeting next. This is Bloomberg.
Season is here.
I think we're all asking the same question.
Just how much earnings growth they're expecting.
Bloomberg is first to break the numbers.
Gilead just coming out right now.
We have Take-Two numbers.
Shares of Pinterest.
Lucid Group coming out with its earnings.
All eyes right now on Nvidia. A lot still to come.
With the smartest insights.
How much bigger could profit and revenue have been?
Better than what the street was expecting. Bang in line with estimates.
We will have full and instant analysis.
Continuing coverage on Bloomberg. Context changes everything.
China's current external stance and military actions present unprecedented and the greatest strategic challenge, not only to the peace and security of Japan, but to the peace and stability of international community at large.
The United States defense commitments to Japan and to the Philippines are ironclad. They're ironclad. As I've said before, any attack on Philippine aircraft, vessels, or armed forces in the South China Sea would invoke our mutual defense treaty.
And of course, we're continuing to monitor this meeting between Japanese Prime Minister Fumio Kishida there after he spoke with the US Congress, President Biden there ahead of a trilateral meeting with the Philippines at the White House. Well, tensions with China dominating the conversation at that summit. Let's bring our East Asia government editor, John Herskovich, joining us now. So the US strategy in terms of holding this three-way summit, what are they aiming to achieve here?
Well, the U.S. is looking for Japan to increase its influence in the region, to form partnerships with the likes of the Philippines, other countries in Southeast Asia, and also to bring this into an integrated network. And before the summit began, the word that was being talked about was a latticed arrangement, various networks, where the U.S. would have its main partners, and those partners would work with others in the region. With Japan, for the Philippines, it's things like helping with Coast Guard patrols, boosting its Navy. And for the summit itself, the talk also extended between Japan and the Philippines, bringing in Australia as part of the network for data sharing, looking at drills with the UK. So it was using Japan as a key focal point in Asia, looking out the South China Sea and talking about their concerns of what they see as the assertiveness of China in the region.
Yeah, and we just heard some of the sound bites there from Kishida and Biden speaking in front of US Congress. So it seems like that was really the message. They're quite tough on China.
Exactly. And this was an unusual speech. Prime Minister Kishida hardly ever makes speeches in English. This is the first by a Japanese prime minister since, I think, Shinzo Abe in 2015 to Congress. And the message was that Japan is a partner that the U.S. can rely on. Its concerns are Japan's concerns, and also Kishida wanted to show his concerns about what was going on with certain things, like talking about U.S. self-doubt when it comes to things like Ukraine, and also providing reassurances with China and security matters.
We may get this trilateral meeting between South Korea, Japan and China at the end of May if it goes ahead. I do wonder how the US feels about that.
The U.S. has been supportive of this process. This three-way with Japan, U.S. and China. I'm sorry, with Japan, South Korea, and China. It's been on hold since 2019 because of COVID and political acrimony. For the U.S., they support its two allies, Japan and South Korea, with going ahead with the process. They see the talks as a positive for the region. And Biden himself, he's spoken with Xi Jinping recently on a number of matters. So the U.S. has no objections to this. And if it goes ahead, it will be good for the three key players in the region to sit down and speak with each other.
That was our East Asia government editor, John Herskovitz there. And other global developments we're tracking this morning include the largest U.S. airlines, which are asking the Biden administration to block new flights for Chinese carriers, citing what they call Beijing's anti-competitive policies. The Airlines for America trade group and several unions have made the plea in a letter to the Secretaries of State and Transportation. Flights between the U.S. and China are growing, but they do remain well below the average 340 per week before the pandemic. U.S. federal agencies have been ordered to analyze emails, reset credentials and secure Microsoft Cloud accounts over concerns about possible Russian hacking. The directive was issued earlier this month by the U.S. Cybersecurity Agency and made public on Thursday. The agency accuses a Russian state-sponsored group called Midnight Blizzard of trying to compromise some Microsoft customers. President Biden is moving to block oil and gas development in millions of acres of Alaska's North Slope with an initiative that could be finalized within days. The administration says it needs to balance oil development with protecting habitat for polar bears, migratory birds and caribou. Companies with leases in the region, including Santos, ConocoPhillips and Armstrong, have objected to the plan. And we'll have more ahead on Daybreak Australia. This is Bloomberg. Well, Apple shares, you can see here that pop that we had in the New York overnight session. That was after a Bloomberg report that the tech giant is preparing to overhaul its entire Mac lineup with AI-focused in-house chips. For more on that scoop, let's bring in our senior tech executive editor, Tom Giles in San Francisco. And Tom, you take a look at the sales that we get coming through from Mac, and this is just really emphasizes why it's coming at such a critical time for the lineup.
Absolutely. This is a device, a product of a set of products that Apple produces that really peaked in 2022. You'll remember that during the pandemic, everyone was going out buying new laptops, new devices, new tablets, and that was a really peak time for them. And we've seen sales of the Mac come down in more recent years. Apple's doing everything it can to refresh the line, to breathe some new life into it, to get people excited about Mac, the whole line, from the iMac Mini to the MacBook Pro and even higher end devices. And to do that, they're going to be equipping it in short order with the highest power chip that they have, the M4.
Tom, tell us about the equipment with AI technology. What does that mean for the consumer, and is that going to be compelling enough as an offer?
Yeah, well, so right now, Apple is seen as something of a laggard when it comes to integrating AI technology, AI capabilities into its end products. We hear a lot from Microsoft. We hear a lot from Google. We hear even a lot from Meta on when it comes to how AI is going to change the user experience. Less so from Apple, but they're gearing up for a big event in June where they're going to talk a lot about how generative AI capabilities are going to change the user experience in everything from the iPhone to the Mac and other Apple products. And so this is a first hint at that. In order to make that work, in order to make those products and show off the AI capabilities in the devices, they're going to be talking about the idea of having a faster chip in it, and that's where the M4 comes in.
Comes at a crucial time for Apple. Our senior executive editor in technology, Tom Jaza, with that Bloomberg scoop. Well, US earnings season beginning with JP Morgan, Citi, Wells Fargo reporting their first quarter results on Friday, and investors will be closely watching the bank's outlooks and commentary around key profit drivers. They are feeling optimistic about another bumper earnings season as global growth continues to pick up. Sally Bakewell leads our US finance team and joins us now. So, Sally, expectations are pretty richly priced going into this.
Yeah, that's right. I think a big driver of it will be the trajectory of interest rate hikes, which, compared to sort of 3 months ago when a lot of the banks were warning the sort of record haul of net interest income, which is their biggest sort of revenue, would probably be over as we sort of were staring at a sort of a faster pace of interest cuts. But now that fewer are expected, a lot of the big banks are actually probably going to increase their outlook for net interest income based off of that. So I think that's something that a lot of investors and analysts are really going to be looking for. And, generally, lower rates mean that people can borrow more, and then the banks, they pay out less on deposits. So it's a sort of difficult dynamic for the big US banks to navigate. But on the whole, the fact that the rates are going to be higher for longer is probably better for big US asset-sensitive banks.
And so what sort of outlooks are we expecting to hear given the level of uncertainty around rates?
I think a lot of people are talking about JP Morgan and Wells Fargo. These two are expected to potentially revise their outlooks. And of course, what their chief executive officers, in particular Jamie Dimon, say about the economy will also be closely watched. Dimon, just on Monday, he talked about how the fact that the markets are pricing in a potential 70 to 80% chance of a soft landing. He sees the odds at much lower than that. And he also suggested that given the number of inflationary pressures that the economy is facing, that we could actually see interest rates in the range of sort of anything from 2% to 8% or even more, and that the bank was prepared for that.
There's an additional challenge for Morgan Stanley. We saw the stock falling the most in, about 5 months overnight. There are these concerns over their money laundering controls by regulators?
That's right. I mean, in a way, not all of this was new. In November last year, we know the Federal Reserve was looking at whether Morgan Stanley's wealth management business was taking adequate measures to prevent potential money laundering. And at that time, the regulator, it was reported, was prepping the firm to improve controls and processes. And Andy Saperstein, who has oversight of the division, had met with Fed officials, promised to improve shortcomings. Now, today we learned that the probe is actually much broader than that, and it's actually the SEC, the OCC, and some other US Treasury Department officers. They're digging into whether the bank has done enough due diligence of the identities of riskier clients. What we don't really know is why the huge share drop, given aspects of the probe are already known, and the bank has made some regulatory disclosures and filings, that the shares dropped, 5-6% was pretty surprising. And we also don't really know the timing, what period of things these apply to, nor the gravity or the heft of these probes and how serious they are.
All right, that was Sally Bakewell, who leads our US finance team, and certainly just underscoring how important these earnings we get from the lenders are going to be later on Friday. But that's the outlook you've got here for stocks. We're 30 minutes out from the open for Australia, Japan and Korea. And futures looking fairly muted so far. Actually, intraday, we saw a move higher for US equities, with Fed officials as well reiterating a patient approach. But certainly today, a lot of data on the eco docket in this part of the world. You've got China's March trade data that's due, expecting exports to show resilience there. You've got Singapore's first quarter GDP, the MAS policy statements up in about 30 minutes from now as well. The BOK coming up. And as we said, the Bank of Korea widely expected to keep rates unchanged after parliamentary elections deliver a blow to President Yoon.
Let's take a look at FX as we head into this last trading session of the week here in Asia. We're seeing really Asian currencies looking to global central banks for guidance here, in particularly when it comes to the Fed. The US dollar is pretty steady at the moment, little changed even after those producer prices rose at a slightly slower than expected pace. That really had a steadying effect on markets that have been hammered by rate sort of easing expectations being pulled back after we had the CPI numbers midweek, right? Those separate figures really driving traders to slash those rate cut bets. We also saw the euro edging a little bit lower after the ECB held rates steady, but signalling a pivot or a path to a pivot to easing. To that end, we're seeing the Aussie dollar holding pretty steady at 65.42 at the moment. We do have really the expectation of improving geopolitical ties with China weighing as a bit of a positive support in this currency as that China proxy. And we also continue to see some improvement of the economic situation there. And of course, watching the yen at 153.22. Questions over how much yen intervention would sort of even help at this point. Well, speaking of China, KKR's co-CEOs say China's consumer sector remains a sweet spot despite the sluggish recovery, but they're avoiding politically sensitive sectors such as AI. Joe Bay and Scott Nuttall told us exclusively that their current focus on Asia includes that revival in Japan.
Asia for us is really an area we've been building and growing for 2 decades now, since 2005, and an area where we have, as a firm, have a really, really dominant position, the largest alts manager in Asia today. So we've grown from 18 billion of AUM to 65 billion of AUM in the last 5 years in Asia, organically, to give you a sense of the type of growth. It's the fastest growing part of the world today. 60% of global GDP growth is coming out of Asia. The most exciting consumer trends are coming out of Asia. So it's a natural place for us to be focused as private equity, as infrastructure investors, as real estate investors. In Japan in particular is exciting. It's around 40% of our business in Asia is Japan. Just given its 2 decades of deflation, it's coming out of this long economic morass. And the implications for Japan are profound in terms of where savings are going, in terms of corporate governance reform, the opportunity for us to really buy great non-core businesses from big conglomerates. So it's a very target-rich opportunity for us.
Yeah, and it's not just in our asset management business. If you look at the life insurance and annuity market, in the U.S. it's a $4 trillion market. In Japan, it's $3 trillion. So it's a massive market across a lot of what we do. And so we see opportunities to expand in multiple parts of KKR in Japan.
A lot of people are focused on Japan right now. KKR has a more dominant position. There's also a lot of focus on China and what to do with that. And a lot of people are saying we're getting out. You do have a significant presence in China. How do you think about how that lives, given the geopolitics of the moment, which are highly uncertain?
Well, listen, our approach to China, I think, has been consistent since we started our business there. We have 3 offices, Beijing, Shanghai, and Hong Kong. So we are committed to that market. But the complexity of investing in China is obviously much higher today. Our focus over the last 2 decades has really been focused on the consumer segment of China, the growing middle class, the urbanization trends in that marketplace, and that's the sweet spot of the opportunity for us. So we've invested in retail companies, branded consumer goods, healthcare. We are not leaning into these high growth areas that are geopolitically sensitive, like semiconductors, like AI. So we've avoided a lot of the areas that are currently creating a lot of turmoil in the market, and we're sticking to our knitting, consumer services.
Well, they were the KKR co-CEOs Joe Bay and Scott Nuttall speaking exclusively with our colleague Lisa Abramovich in New York. And taking a look here, we've got markets 30 minutes out from the session opening here in Sydney, Seoul and Tokyo. At the start of the day, we're actually just watching those Japan futures in particular because you can see that pop there. That's the futures contract listed in Singapore that's just come online, pointing to a little bit of a jump here. So sort of follows what came through overnight in the US session when we saw that rally in equities there on Wall Street, driven by this expectation around earnings season. We are expecting some pretty solid numbers coming out, particularly from big tech names, and they're going to be ones that we'll be watching in particular. What else we're tracking in the session really is just the sheer amount of data we're expecting today. You've got export numbers that are due from China. You've got exports that are expected to show resilience for China's economy. Other decisions or things that are coming out as well is to note, Singapore is due with its GDP figures, also an MAS decision. And then also tracking, of course, the Bank of Korea. That is due just in the next hour, perhaps. Tight job market there, perhaps, is going to be allowing the central bank to wait just a little bit longer until they decide to pivot. But we'll have more ahead on that. And coming up as well, an Australian activist hedge fund has lodged returns that are almost double the country's benchmark. We ask L1 Capital to share the market strategy behind their success next. This is Bloomberg.
All right, taking a look at how US futures are shaping up after what was a session that was really largely led by the revival of the Magnificent Seven, right? Tech sending parts of that market higher. We are seeing S&P futures looking largely flat at the moment. Of course, we've had mixed messaging when it comes to the data. The two pieces have really kind of driven investors to reprice Fed cut expectations. We had the hotter than expected CPI number on Wednesday, but then the producer price number that came in overnight was actually a little bit softer than expected. So we see that kind of muted reaction across some of those US assets, including the US dollar, looking pretty flat at the moment. Nasdaq futures, though, a little bit to the upside there. We're seeing the Dow up by about 0.1% there as well. We had quite a bit of Fed speak as well, including hearing from Susan Collins saying that the data may warrant later fewer cuts this year from the Boston Fed chief. Well, here at Australia, investors are getting more engaged in activism, with clashes between firms and shareholders picking up in the last 2 years. It is a shift in a market that hasn't historically seen the table-pounding playbook seen on Wall Street from the likes of Carl Icahn and Bill Ackman. Our deals and banking reporter Harry Brumpton joins us now. So, Harry, are things starting to change?
They seem to be, yeah. I mean, when I talk to investment bankers across the region and financial advisors, Heidi, you know, they say it's one of the top conversations on boards and CEOs' minds is, you know, will activism kind of arrive in Australia? And it has a little bit of precedent here. I think, you know, Goldman Sachs advised BHP when Elliott came in the stock in 2018, and it prompted a lot of conversations around the region, like, is this the new thing that we're going to see? You know, a few years went by, I guess COVID happened, and it hasn't quite taken off, but there's, you know, emerging signs, and I think you know, people are starting to value it and realise that there's a playbook there, and it's starting to crop up. You know, local investors, whether wealthy individuals or, you know, Australia's pension industry, you know, it might not be US funds coming in and really like wreaking havoc on the Australian market, but it doesn't mean that people can't reverse engineer that playbook and use it to their own ends and really adopt that style of engagement where it's needed to get the outcomes that they want.
So why haven't investors and shareholders been, I guess, more feisty in Australia?
There's a couple of reasons. I mean, I think if people are perfectly frank with you, you know, about Australia's market, you know, we are a small market with 25 million people here in Australia, and so, you know, it's a very small commercial realm, and it's hard to, you know, come in and start swatting people around and making enemies. So, you know, traditionally people have shied away from that. The other element that has stopped the US funds coming in, or at least, you know, foreign funds from really getting attracted to Australia, is that it's really just not, it's a pure time zone issue as well. I mean, we are on the complete opposite end of the clock. People don't really want to sit on a board in Australia or lobby for a board to get a board seat when they know they're going to have to be working around the clock on this, and it breeds all sorts of problems. So that's, you know, conventionally what's kind of held back a lot of that asset class from coming down under, as well as just opportunity sets elsewhere in the world that, you know, maybe richer.
And as we know, as you've just written about, it can be hugely rewarding and lucrative, right? And Harry's going to stay with us. We're joined now by one of Australia's most prominent activist hedge funds. They're notching returns nearly double that of the country's benchmark stock index. James Hawkins is an L1 Capital partner. He's a head of the Catalyst Fund, and he joins us now from our Melbourne studio. James, really great to have you with us. So we've just been talking with Harry about this kind of revival. I'm keen to get your thoughts as to how strong this hold is in terms of seeing more activism within Australia's capital markets.
Yeah, good morning. Thank you for having me. I think you're going to see a lot more activism in the Australian marketplaces, as activism in Australia has really migrated from having a stigma associated with it to being accepted and to being valued. And the key thing is that activist funds like our Catalyst Fund have alignment with the companies in which we invest, because we're a long-only fund. So I think you're going to see a lot more of it, be it through dedicated Catalyst funds or activist funds through dedicated activist strategies within, the sort of the mindset of the large industry super funds, and then also some of the high net wealth individuals that are also being more activist in respect of their public equity investments.
Yeah, I think, James, you hit on an interesting point there that, there's been these pockets of capital that have emerged in Australia that have adopted the playbook. I mean, probably one of the first was Mike Cannon-Brookes, the billionaire founder of Atlassian, and he got really down the rabbit hole that in terms of using tactics that we would have seen from traditional corporate raiders. He accrued a stealth stake in energy company AGL, and he's been pushing to kind of change the company's environmental outlook. He accrued a stealth stake, got up to 20%, and then he did the full works, a full media presentation, a website, hired proxy advisors. Is this the way it is? Are we going to see it not from hedge funds per se, but more wealthy individuals, mining magnates like Gina Rinehart derailed Albemarle's $4.6 billion takeover offer for Liontown Resources last year, and then the super funds as well that have this just immense quantum of money under and we can money under management. We can kind of talk about some of the examples in that case as well. Do you expect that that's how we'll see this going forward? It's not just hedge funds, it's also wealthy individuals, super funds just kind of throwing their weight around?
Yeah, I think you're going to see many different types of investors, Harry, pursue this activist type of strategy in Australia, and you've touched on some. I think the recent example with Australian Super and Origin, and them saying no to the Brookfield EIG proposal to be taken out. That's another example of the industry super funds flexing their muscles. So yes, I think going forward you're going to see different pools of capital that are probably motivated and encouraged by the dedicated activist funds, really showing the market how activism can be actively deployed and effectively deployed to create investment returns that outperform the market.
What do you think? Thanks. What do you think the species of activism looks like here in Australia? Conventionally, we've seen probably more what's called a constructivist approach. Do you expect that to continue, James? There's been funds like Tanara, run by the former Lazard dealmaker John Wiley, often take a seat and accrue a stake, and then work with the company behind closed doors. Before, if they need to, they'll go public and, start throwing their weight around. But conventionally, that hasn't been their approach. And is that the L1 approach as well? You have a lot of levers outside of just, busting up a company and asking for breakups. For you, it's, it could be CEO changeover, dividends. Is this what it looks like here in Australia versus the kind of corporate breakup model that people conventionally think of activism as holding?
I think there's a full spectrum of activist playbooks, Harry, that can be utilised in Australia. The examples I give at one bookend, I would call it the capital A activist approach, which is to go public and be very, very explicit with your ask. And then at the other end of the playbook, which is more common, I call it the lowercase a activism form of playbook, which is more constructive, more behind closed doors. And I think in Australia we're going to have our own, I like the term you used, Harry, our own species of activism, which is we're a small market, everyone knows everyone, and we have our own way of doing business. So I think in time you will see a particular form of activism evolve in Australia, having regard to our people, our way of doing business, and also the sector composition of the Australian market, which is, we have a very large component of the market which is resources, which is unique to Australia, and there's a certain way of doing business in that part of the market.
James, this has also kind of coincided with a few banner years for M&A. Do you see this as being just a coincidence? Does the kind of rise of activism transcend market conditions?
I think activism can exist and evolve throughout all market conditions. It can be a beneficiary if you're a 10-stock portfolio and one of the companies in which you invest are the subject of corporate activity. But I think what's important about activism is it can take many different forms. It can be strategic, financial, operational or governance related, and a lot of those types of activism exist separate and distinct from M&A activity.
ON Capital partner James Hawkins and Bloomberg's deals and banking reporter Harry Brumpton on the rise of activist investment here in Australia. We do have more ahead on Daybreak Australia. This is Bloomberg.
Global banks are ramping up their roadshows for clients eager to bet on Japan as the market becomes a hot destination for fund flows. For more, let's bring in our Asia investing editor, Russell Ward in Tokyo. And Russell, it just seems like everyone out there is really just looking for more information from Japan and also from people that are really on the ground there.
Absolutely, Val. Yeah, I mean, there's obviously been enormous interest in Japanese stocks. And so what we're seeing here in Tokyo is the Wall Street banks that have a long presence in Tokyo are ramping up their research services, getting their analysts out in front of clients. So we're seeing Citigroup has been holding Japan days worldwide, getting their research analysts and even their local head and traders out there to share the information that they have on the Japanese market. We also have Morgan Stanley's joint venture with MUFG has been going on the road as well, sending its analysts to Hong Kong and Singapore last month. So they're really ramping up this activity, ramping up their marketing of their research just to, tighten up ties with clients and share the information about this market where there's just this enormous excitement.
Russell, are we getting an indication of what kind of the next leg of focus is going to be for foreign investors, right, given that we're a fair bit into this rally now? And there are sort of a few more concerns around the edges as to what could be the downsides to come. We had a call from Citigroup earlier.
Yeah, certainly there seems to be a bit of an inflection point since the BOJ raised interest rates. A lot of jittery markets, obviously external forces with the Fed as well. But really, I think, one of the key factors here in Japan is the upcoming earnings season. There seems to be a lot of optimism among investors that because inflation is becoming more sustainable, that's going to help companies, in terms of their profits, basically. And also, there's also, optimism that this momentum for corporate governance reforms and companies, paying more attention to shareholder value is going to sort of gain momentum as well. So whether we'll see that in the earnings season in terms of more buybacks and increasing of dividends and things like that. So really, a lot hinges on the coming weeks, and just to see whether this excitement really has some momentum.
All right, that was our Asia investing editor, Russell Ward, there in Tokyo. And shifting as well to the Bank of Korea, because the decision due as early as the next hour, but it's expected to keep its policy settings unchanged when it announces that rate decision. So policymakers, they're meeting as the nation undergoes a major political change as well. Our Asia Economy and Government Senior Editor, Brian Fowler, joins us for more. And Brian, it really just seems like the BOK not quite ready to shift away from its restrictive stance just yet.
Yeah, that's absolutely the case. Every economist we spoke with said he and she expects the BOK to hold at that 3.5% rate, which, as you said, it characterizes as restrictive. And that makes sense, first of all, in light of recent inflation trends. Last month, we saw inflation come in at 3.1%. That beat consensus. And, of course, it's above the BOJ's 2% target range. And then, as you mentioned, politics. If you think about what happened on Wednesday, one of the big topics on the minds of voters when they went to the polls was rising frustration about the cost of living, which is shooting up. And we saw how that played out for Yoon and his party. Just from the standpoint of optics, it wouldn't look very good for the BOK to come out 2 days later and cut interest rates.
There are also multiple channels, where a Fed move would affect South Korea, right? How does that play into this?
Yeah, that's a big part of this. So, of course, in the U.S. as well, we've seen inflation much stickier than expected, and that's pushed back expectations for Fed rate cuts this year. And that, of course, all things being equal, is going to support the dollar, which, of course, puts downward pressure on Asian currencies. The yen is a big part of that, but the yuan as well has been one of the weakest currencies in Asia this year. And that's a big problem for a country like South Korea that relies heavily on imports of fuel and food, because that, of course, could push up cost-push inflation, which would make things worse for households dealing with tighter budgets.
The broader trend for inflation, though, is still down. So do you think that there's any sort of risks that are associated with staying high for longer?
Yeah, well, first of all, one thing we're going to look at, last month the board came out and they said regarding the outlook for inflation, they said it's too soon to be confident that inflation is going to slow to our 2% target range. So we're going to look and see how they characterize their expectations today. And yes, of course, there are risks. Companies that are dealing with debts in the property sector are going to be under pressure because of high rates. On the other hand, industrial production has held up pretty well. Exports have held up well. Semiconductors, output of semiconductors in February was the highest in 14 years. So there are indications that the economy is holding up pretty well, even with rates at this restrictive level. And so it's too soon to really think that the economy needs any kind of help in terms of easing.
Brian, we're of course following, as we do really every morning, the jawboning from Japanese officials on currency, right? We're hearing from the Japanese Finance Minister, Shinichi Suzuki, again, speaking in Tokyo, saying it's important that FX move stably, reflect fundamentals. They cannot comment on recent moves, but excessive moves are undesirable, that they're not ruling out, again, any options against these excessive moves, and appropriate responses will be taken. So that sense of urgency still being conveyed. When it comes to currency intervention, as we see kind of broad-based weakness in response to the dollar across Asia, how useful and how impactful and sustainable would it be for Japan to do that at this point?
Yeah, that is such a critical question, because I think there's a risk. I mean, the Japanese officials have been very careful. For example, in their verbal intervention recently, this month, they have not used the phrase, "we are ready to take bold steps," which is a direct reference to intervention, a direct threat. They haven't gone that far. And I think there's a concern among officials that if they play out their intervention threat and it doesn't work, then things are going to be even worse, even more chaotic. And there's a real sense that what's really driving the dollar-yen higher is what's happening in the U.S. with these Fed rate cut expectations being pushed back, and the outlook for rate differentials staying wide for much longer than we expected. So, yeah, that's a key thing. I think there's a risk that intervention might not work, and they're aware of it.
All right, Brian, that was our Asia Economy and Government Senior Editor, Brian Fowler there.